Eye-watering. Scary. A generation of old homeless people unable to afford a comfortable lifestyle on meager pensions. These are the words of investment industry professionals responding to new data which describes the scale of the pensions and retirement savings crisis. If you're watching this, the chances are that you and millions of other people need to take urgent action. Let's get into it. New research from Interactive Investor, a UK investment platform, shows that due to soaring inflation and the cost of living crisis, people now need to save almost £69,000 more to enjoy a comfortable retirement than they did a year ago. Interactive Investor's head of pensions and savings describes this as eye-watering. According to II, pensioners now need a total income of £47,000 for a comfortable retirement, compared to £43,000 just last year. To generate that additional £4,000 of income, people will now need to save a total of almost £600,000. That's £69,000 more than a year ago. One investment industry contact that I know called this a reality check. Another called this terrifying, and another scary, and I agree. I really don't like to be negative and blow things out of proportion, but after 15 years in the investment industry, I really do believe that there's an emergency to deal with here. Pensions and retirement saving is a ticking time bomb for too many people. According to the Office for National Statistics, or ONS in the UK, the median pension retirement savings for 55 to 64-year-olds in the UK is just £107,000. That's almost £500,000 less than they need for a comfortable retirement.
I'm just checking your math on that. Yes, I got the same thing.
Combine this with the fact that many people can't afford to buy homes. Another industry contact suggested politicians need to wake up to the fact that they'll be facing a generation of old homeless people unable to afford their rents on their meager pensions. Another contact suggested that to buy an annuity, that's an insurance contract that pays you a guaranteed income in retirement, you would need a pot of £750,000. And to get it index linked, so it rises with inflation, that would cost you a cool £1 million.
What?
The problem is the same in the US too. The average 401k savings account for 55 to 64-year-olds, that's those at retirement or near retirement, is just $71,168. That's according to Vanguard's latest How America Saves report. So this pensions crisis is arguably worse in the US than it is in the UK, especially when you factor in healthcare costs, which typically rise as you get on later in life. How did we get here, you might ask? Well, the biggest reason in my view is that the responsibility for pensions and retirement savings has shifted to the individual away from companies. Most employers used to provide what are called defined benefit pensions, where you were guaranteed a certain level of income in retirement, or a defined benefit. The problem with that system is it created a number of final salary schemes and career average pensions, which saw many people retiring as early as 55 years old and living 30 to 40 years in retirement. This was really expensive. This hurt company profits and balance sheets and exposed their businesses to market risk. If the scheme funding level dropped for stock markets, companies had to increase their contribution rates to make up the deficits. This hurt profitability, share prices, and company valuations. And CEOs don't get paid big bonuses when that happens. So the bright idea was to move away from defined benefit pensions to what are called defined contribution pensions. These are your typical workplace pension schemes now in the UK and your 401ks in the US. Defined contribution pensions, or DC pensions, are different, as the contributions are fixed or defined, not the payments or benefit. And the risk is transferred from the company to the individual. The sneaky thing here is that DC pensions have proven much cheaper for companies. DC company contributions are typically lower than those offered through DB company pensions. The other thing that has contributed to this crisis has been a complete lack of adequate financial education and advice for people. In the UK, we launched something called auto-enrollment in 2012, which automatically enrolled people into a workplace pension scheme. Sounds good, right? The UK's pensions regulator has hailed this as a big success.
A great success!
With figures showing that millions more workers are now saving into company workplace pension schemes. Again, this sounds great, but the problem here is that many companies have implemented the minimum auto-enrollment contribution rates of 8% of qualifying earnings. And to break it down, employers must pay a minimum of 3% of salaries into the employee's pension scheme, and the employee has to pay 5%. And the total 8% of your earnings that goes into your pension, well, it's not enough to afford a comfortable retirement. Many industry commentators have called for contribution rates to be scaled up to above 12%, and some have even called for it to go as high as 16%. And I hate to say it, but this still isn't enough. The rule of thumb that I was told by a very senior industry executive is half your age, meaning that if you're 30, you need your total contribution to be 15% between you and your employer. If you're 40, then that means 20%. And let's be honest, most people aren't getting anywhere near that. So what can you do to avoid a bad outcome here? First, you need to accept reality. As harsh as that might sound, the best way to deal with a problem is radical acceptance. No amount of hope or optimism is going to change the fact that you, along with most people, aren't saving or investing enough for retirement. I can't sugarcoat this one. I really wish I could. Second, you need to make a plan. Start by calculating how much money you'll need for a comfortable retirement. Consider factors like your age, your desired retirement income, expected inflation, and anticipated expenses. There's a lot of free pensions calculators online, but here's a spoiler. Ignore what the government recommends. You need to do the work and calculate what you need based on your circumstances. Third, make sure you're maximizing employer contributions to your pension. If your employer offers matched contributions that rise with your contribution, then make sure you contribute enough to max out that benefit. It's essentially free money for your retirement. If you put in 10%, they'll put in 10%. That's like getting 100% return on your investment immediately. That's a pretty good deal. Fourth, take more risk. This is somewhat controversial, and I'm not saying go and throw your life savings in a single stock or cryptocurrency. What I'm saying is, if you get an option to put your retirement savings in a higher risk, diversified portfolio, and you have 10 to 40 years until you retire, you might as well go large and invest 100% in equities. As I said in my recent video on the S&P 500, this one investment has outperformed Vanguard's life strategy fund on a 1, 3, 5, and 10-year basis. As uncomfortable as taking more risk may sound, it's hard to argue with that data. Fifth, be consistent with your investing. When you take more risk, you'll invariably experience more portfolio volatility. As I said, this will feel uncomfortable, but this can be a good thing. The solution here is to invest consistently through the good and bad times. If you do this, the price you buy at will fluctuate, meaning your average will middle out. This is called cost averaging, and it's a super smart way to invest. Sixth, take advantage of bear markets and market dips. The other trick is to hold a cash bucket, which you can invest when there's a bear market or a significant market dip. I heard a lot of stories during COVID about big institutional investors plowing huge sums of money into the stock market when markets were down 30 to 40%. This is such a simple strategy to just bolt onto your regular contributions. Seventh, be vigilant around fees. High fees can definitely erode your returns over time, so always choose low-cost investment options where possible and appropriate. In big developed markets like the US, it's hard for active managers to generate alpha due to what's called information efficiency. Information efficiency is a technical term which essentially means all investors have access to all the information at the same time. This isn't true for all markets. Some markets are less informationally efficient than others. So I like active investing for emerging markets and frontier markets. Put simply, if you're seeking exposure to tech companies in the Philippines, Taiwan, India, it's probably better to go active. In the investment industry, coupling passive investments with active investments is known as a barbell strategy. And lastly, get professional advice from a qualified financial advisor. A lot of people hate this idea, but the truth is rich people use financial advisors. They use them for tax planning, cash flow management, investment management advice, and coaching and accountability. They're a bit like a boxing trainer sitting in your corner watching out for you. But be careful, you don't want to overpay them either, and I'll do a separate video on working with financial advisors very soon. So there you have it, my 8-step plan for dealing with the ticking time bomb pensions crisis. As I said, this has the potential to be frankly devastating for millions of people. And I hope this video gives you the reality check, inspiration, and actionable guidance to help you take control of your situation and take positive action. As I said, one of the simplest and cheapest ways for you to start building a diversified portfolio is to use an S&P 500 ETF or index fund as a building block within your portfolio. So you can watch this video next to understand the factors that I believe are important for you when considering which S&P 500 ETF or index fund to invest in. But remember, the S&P 500 is just one market that you can get exposure to. So I'd also recommend diversifying your portfolio internationally away from the S&P 500. I'll do another video on this in the coming weeks. Until then, keep investing selectively and effectively.